The Fed's dilemma: to cut or not to cut. Imagine a seesaw. On one side we have inflation. It's like a mischievous kid, pushing prices higher and making things more expensive. On the other side we have economic growth, which we want to keep strong and steady. The Federal Reserve, or the Fed for short, is like the grown-up trying to keep this seesaw balanced. And right now, the Fed has a tough decision to make. Should it cut interest rates in September 2024? The Fed's September meeting is shaping up to be a nail-biter. Economists and investors are eagerly watching for any clues about whether the Fed will raise rates, cut them, or leave them unchanged. The stakes are high, and the decision could have a ripple effect throughout the U.S. economy. Will the Fed prioritize taming inflation, or give a boost to a slowing economy? This decision is not just about numbers, it's about the livelihoods of millions. Families, small businesses, and workers across the nation are all waiting to see how this decision will impact their daily lives. And it's not just the U.S. watching. Global markets are also on edge, as the Fed's decision could influence economies worldwide. As the clock ticks down to the September meeting, all eyes are on the Fed. The world waits with bated breath. Adding to the complexity, a new government revision of jobs data revealed that the U.S. job market wasn't as strong as it appeared to be in much of 2023 and early 2024. Employers added 818,000 fewer jobs in the 12 months ended March 2024 than were originally reported. Decoding the Fed, America's economic guardian. The Federal Reserve is like the central bank of the United States, playing a crucial role in the nation's financial system. It's responsible for keeping the U.S. economy healthy and stable, ensuring that it runs smoothly. One of the Fed's main tools is setting interest rates, which can influence the entire economy. Think of interest rates like the price of money, affecting how much it costs to borrow or save. When the Fed raises interest rates, it becomes more expensive to borrow money, impacting loans and mortgages. This can slow down inflation, but also potentially slow down economic growth, affecting businesses and consumers alike. The Fed doesn't make this decision lightly, as it weighs the potential benefits and risks. It looks at a whole bunch of economic indicators like inflation, unemployment, and consumer spending to make informed choices. It's like putting together a giant economic puzzle where every piece matters. The goal is to keep inflation in check while also allowing for sustainable economic growth, balancing both aspects carefully. It's a delicate balancing act, and the Fed's decisions have a big impact on all of us, influencing our daily lives and financial well-being. The U.S. economy today, a mixed bag. So, what's the U.S. economy looking like these days? It's a question on everyone's mind. It's a bit of a mixed bag with both positive and negative indicators. On the one hand, the job market is showing signs of weakness with rising unemployment rates and recent job losses. People are spending money, which is good for businesses and helps keep the economy moving. But on the other hand, inflation is still higher than the Fed would like, causing concern. This means that things are more expensive and people's paychecks don't stretch as far as they used to. This mixed economic picture is making the Fed's job even harder as they try to balance growth and inflation. Cutting interest rates could help boost economic growth and prevent a recession, which is a period of economic decline. But it could also make inflation worse, leading to higher prices for everyday goods. On the other hand, keeping rates high could help bring down inflation, but it could also increase the risk of a recession. It's a tough call, and the stakes are high for everyone involved. Rate cut conundrum, a double-edged sword. Cutting interest rates is a bit like giving the economy a shot of caffeine. It can make things feel more exciting in the short term, but it's not a long-term solution. Lower interest rates make it cheaper to borrow money, which encourages businesses to invest and hire more people. This can lead to economic growth. However, there's a flip side. If the economy gets too hot, inflation can start to rise even faster. This is like blowing too much air into a balloon. Eventually it will pop. The Fed has to be very careful not to overheat the economy with rate cuts. September surprise. What's next for the U.S. economy? So, will the Fed cut interest rates in September 2024? It's hard to say for sure. The Fed will be closely watching economic data over the next few months. If inflation starts to cool down, the Fed might feel more comfortable cutting rates to support economic growth. But if inflation remains stubbornly high, the Fed might have to keep rates high, even if it means slowing down the economy. The Fed's decision will have a big impact on all of us. It will affect everything from mortgage rates to car loans to the stock market. It's important to stay informed about the Fed's actions and what they mean for your personal finances. Join the conversation. Express your Econ Finance insights. What do you think the Fed will do in September? Share your thoughts and predictions in the comments below. And don't forget to like and subscribe to Express Econ Finance Insights for more in-depth analysis of the economy and financial markets. Let's unravel the complexities of the financial world together.